Welcome you all for the session on derivatives market. I am Dr. Dinesh, Assistant Professor, School of Management, Shastra Deemed University, Tanjavur. In this session, I am going to explain about the meaning of derivatives, the current scenario of derivatives market in India, different types of derivatives, market participants, and we'll discuss about the rolling and settlement in derivatives market. So let's start with the meaning of derivatives. It means the value of an asset will be determined based on the underlying asset. It means that derivatives are not having the independent value. So the value of that instrument is determined based on the underlying asset. So that particular instrument is called it as a derivatives. There are different types of derivatives or different types of underlying assets are being used to determine the value of derivative instruments, including securities, currencies, commodities, interest rate together taken as an underlying asset to determine the value of derivative instrument in the market. So I'll start with the meaning of derivatives. The term derivative, it indicates that it does not have any independent value. It means the value is purely depends on or derived from the value of underlying assets. So the underlying asset, it can be securities, commodities, bullion, currency, livestock, or anything else. So in this meaning, you're able to understand about the meaning of derivative. So the derivative does not have any independent value. So the derivative value is purely depends on or derived from the value of underlying asset. So what are the underlying assets are being used in India? It is used and it can be classified as securities, commodities, bullion, currency, livestock, or any other thing that can be included. It is like interest rate. The kind of instruments are being used as an underlying asset. There are different types of derivatives. We are classified into the financial derivatives and commodity derivatives. So here we are going to see about the financial derivatives. The financial derivatives, it means in a financial derivatives, the underlying instrument, it may be a treasury bills, stocks, bonds, foreign exchange, stock index, gilt-edged securities, cost of living index, and other related instruments are being used in the financial derivatives. So the financial derivatives is purely based on the investments. So based on that, what may happen in that to the respective instruments like treasury bills or stocks or bonds or foreign exchange. So based on that, the future value will be determined. So this particular derivative, we call it as financial derivatives. The second one is a commodity derivatives. In a commodity derivatives, the underlying instrument is a commodity which can be a wheat, cotton, pepper, sugar, jute, turmeric, corn, soya, bean, crude oil, natural gas, gold, silver, copper, and other materials are also taken for determining the commodity derivatives. So for enter into the contract, so what would be the price that the sugar in which they are going to enter into the contract? It is based on the current price. It is based on the prevailing price in the market. So what basis we are going to derive the future value? So it is based on the underlying asset. It is based on the prevailing asset in the market. So it is, we call it as commodity derivatives. And in financial derivatives, it is there are the different types of contracts or different types of tools are being used in the financial derivatives. So the tools are like the futures, forward options, and swaps are the major tools are being used to manage the assets, portfolios, and handling of financial risk associated with the instrument. For that particular purpose, the financial derivatives are using these tools. And the prices of these financial derivatives contract is purely depends on the spot prices of the underlying asset. So the spot prices, it means in the cash market segment, or it is in the prevailing market price of the securities available in the market. So it is on that the particular basis we are calculating. Along with this, cost of carrying asset into the future and the relationship with the spot prices. So these parameters are taken into consideration while we are going to fixing a price for the derivative, or while we are going to derive the value of the asset into a future. We are considering the spot price, we are considering the cost of carrying the asset to the future, and we are considering the relationship with the spot prices. So how, if the spot prices are tend to change, what would be the price is expected that the particular stock or a particular bond or a particular foreign exchange will tend to react in future. So it will be identified from this. For example, the forward or future contracts are similar in nature, but their prices in future that may differ. It is compared to that, it is based on the spot prices. It is based on the relationship with the spot prices, it is tend to change. And before using any financial derivative instruments for hedging, speculating, or arbitraging purpose, the trader or investor must carefully examine all the important aspects related to them. It is a risk or the kind of elements related to these instruments are being verified before going to understand or before going to use the financial instruments. The term financial derivatives related to the variety of financial instruments, which include stocks, bonds, treasury bills, interest rate, foreign currency, and other hybrid instruments, are together used to determine the value of future asset. It is being used in the financial derivatives. The financial derivatives, which includes the futures, forwards, options, and swaps. The financial derivatives also enter into the future contract, are the most important form of financial derivatives. The financial derivative, it is also be as a derived from the combination of cash market instrument or any other financial derivative instrument. So it is based on that the financial derivatives or the instruments under the financial derivatives is determined. Is purely determined based on the cash market segment. In that, what would be the prevailing price of the particular instrument? Either it may be a stock or a bond or a foreign exchange. So what would be the price? It is available in the cash market. So based on that, the future price will be determined. Based on that, the contract will be created. And the future market is based on the different parameters. The future market is also based on the financial market. So the financial market derivatives, it can be defined as the treasury or the capital market instrument which is derived from or bear a close relation to the cash market instrument or any other derivative instrument. Hence, the financial derivatives are the financial instruments whose price are derived from the prices of other financial instrument. So that we call it as financial derivatives. Say for example, if I'm going to enter into a contract, I'm going to buy a financial derivative, I'm going to buy a future of ICICI Bank, I'm going to buy. With that, I'm going to considering the price at which the ICICI Bank is available in the cash market or in the spot market. So based on that, the contract will be created. So it is purely based on this particular parameter. So it is, we can say, while we are entering into the financial derivatives, it is purely based on the financial instrument. It is also comparing the financial instrument in which the price of the financial instruments available in the spot market, based on that the future market price will be determined, or the financial instrument price is determined under this condition. And the future contract. To enter into a topic, you need to understand what are the futures. So the financial derivatives, we have futures, we have options, we have swaps are included in the financial derivatives. So the first one is a future. The future is defined as, the future is a contract, it is between the two parties where both the parties are agreed to buy and sell a particular asset on specific quantity and at a predetermined price at the specified date in future. They are enter into the contract, we call it as future contract. So that the future contract is based on the buyer and seller who would like to buy that particular contract, who would like to sell that particular contract. So they are enter into that, and they will be engaging, or they will be making an contract. It is based on the specific amount of quantity, or specific quantity of instruments are being traded in the market. If one is interested to buy the ITC from the market, 100 shares of ITC from the market, so I would like to buy it from the market with a specific rate. If it is like 200 rupee or 250 rupee, 250 rupee I would like to buy. So another one person in that the position, they need to sell that particular ITC limited, then that particular contract has been created. So it is purely between the two parties, whereas they agreed to buy and sell the particular asset with respect to the specific quantity and with the predetermined prices and the specific date in future. The contract will be executed. It is, say for example, 21st of January 2021 I am going to buy. At the same time, the seller is going to sell that particular instrument on 21st January 2021. So that the contract will be executed. So this is, we call it as future contract. And there are two types of future contract. We classified into commodity futures and financial futures. So the financial futures are furtherly classified into single stock futures, stock index futures, foreign currency futures, interest rate futures, bond index futures. So with this classification of financial futures, the single stock futures, it means a future contract are available on 139 securities stipulated by the Securities Exchange Board of India. So these securities are allowed to be traded in the market, allowed to enter into the contract, allowed to enter into the future contract in the market. So these 139 securities can be traded, can be entered into the contract of future. So these securities are traded in the capital market segment of the stock exchanges. So in this, the future contract is expired on the every Thursday. It means the last Thursday of expiry month. With that, the contract is expired. If the last Thursday is falling on the holiday, the contract is expired on the previous trading day. It may be Wednesday, the contract will expire before that particular working day. And the future contract have a maximum of the 3 months trading cycle, which is denoted as near month. It means 1 month. Next month, it means a 2 month. Fair month is a 3 month. Maximum of 3 month contract can be entered into the future contract. The new contracts are introduced on the trading. It is a trading day following a expiry of nearer month contract. The new contract are introduced for a 3-month duration. This is the way at any point of time there will be 3 contracts are available for trading in the market. For each type of securities it is available. It is 139 securities which are traded in the market for enter into the future contract. For those securities, the 3 months contracts are available for each securities. It means 1 near month, 1 mid month and 1 fair month duration the contracts are available. For example, in this you can understand that in the underlying category there are 2 indexes are traded in the National Stock Exchange. It is Nifty 50 and Bank Nifty. It is available for future contract. Similar to this, you can take, there are about 137 securities are traded in the future contract. So if you want to know about the details of this contract, you just have to click on this, like Titan Company Limited.